some young adults feel that they have the rest of their lives to get serious about their finances. So while they're young and while they have few responsibilities, for many, this is the perfect time to really live it up and have fun. But good money habits do not develop overnight. It often takes a lot of trial and error. So if you are waiting until you get to your late 20s or maybe your early 30s to start getting serious about your finances, you're really getting off to a late start. And the best time to really figure things out is when you're young. And when I say young, I'm talking about that 18 to 25-year-old range. So in today's video, we are going to look at money tips that can help young adults. Now, even though the video is specific to a younger crowd, if you are older, you know, these tips, they really can benefit anyone no matter where you are in your stage in life. However, a lot of my suggestions will be tailored to a younger crowd. The first vital tip to manage money as a young adult is to create a budget. And I think a lot of people make the mistake of not getting into a budgeting routine early in life. That is how I felt when I was a young adult, when I was in my early 20s. I had a job, but my parents, they did not charge me rent. So my money that I brought in, it was pretty much my money to do whatever I wanted with it. And that was exactly what I did. Budgeting was not on my radar. And to be honest with you, I don't even think the word budget was even part of my vocabulary at that time. But even if you don't have a lot of expenses, a budget is necessary, not only because it creates a plan for your money, but also because it teaches you self-control, which is something that a lot of people lack. When you know what's coming in and what's going out, you're more conscious of how you spend your money. But without a budget, it's easy to overspend in areas like entertainment, recreation, and shopping. And learning how to budget when you are young is also important because once you get into a routine of just going about your finances without any type of spending plan and just spending money however you want, it becomes so hard to break this habit as you get older. And if you can't break the habit, as your income increases, so does frivolous and impulse buying. So as soon as you get a job, whether it's a part-time job or it's a full-time job, come up with some type of plan for your money. This way, you're just not out spending your money all willy-nilly and not knowing what's happening with your finances. Keep in mind, though, that a budget is not only useful for those years when you're not earning a lot of money. As your income increases, it's important that you continue to stick with a budget because by doing so, that is going to really help you to live beneath your means, and it's going to help ensure that you always have money for the things that you need. It's also important that you establish a credit history when you're young. Now, some people prefer not to use credit, and that is perfectly fine. However, if you plan to buy a house in the future or maybe apply for other loans down the road, having an established credit history will make your approval process a lot easier. Getting a credit card is one of the easiest ways to build a credit score. You get an account, you use the card responsibly, and the bank reports positive activity to the credit bureaus. Sounds simple enough, right? The problem, though, is that building credit can be a catch-22. You need credit to build credit, but it's often difficult to get credit when you don't have a credit history. Now, if you're looking to establish credit with a credit card, your best bet is really to apply for a secured credit card. Now, these credit cards, they work just like any other credit card, but they are unique because in order to qualify, you have to give the bank a security deposit, which acts as collateral. Now, security deposits, they can be as low as $250 or as high as $1,000. And basically, your credit line will be dependent on how much you give the bank. So if you give the bank a $500 security deposit, you will then get a secured credit card with a $500 credit line. To be clear, though, this is not a prepaid card. So when you use the card, you will still get a monthly statement and you are required to make at least your minimum monthly payment. Although you should always pay off the card in full every month to avoid debt. And once you make this deposit, the bank, they will take your money and they will hold it in an interest-bearing account. And usually after about maybe 12, 18, or 24 months, the bank will then review your account activity. And if you have demonstrated a record of timely payments and managing the the account responsibly, the bank, they may refund your security deposit and then convert your secured card to an unsecured card. But this is just one option for building credit with a credit card. You can also apply for retail credit cards, which are also easier to get without a prior credit history. And there's even the option of getting a credit builder loan. These are unique, and some people have never heard of these, but if you go to a credit union, sometimes they will offer these loans that are designed to help you build your credit history. But there's something you have to know about these loans first, because they are really unique, and some people even refer to them as a reverse loan, because once you are approved, you don't get immediate access to the funds. Instead, the bank will take these funds and they will deposit it in an account, and each month you will make payments to the bank. And once you pay off the loan, which usually you'll have a term of about 12 months, the bank will then release the funds. So it's not the best option if you need immediate funds, but if your sole intent is to build credit and you want to use a loan to do that, it is a way to do it, because the bank, they will report your activity to the credit bureaus, which will gradually increase your credit score. But even though using a credit card is a convenient way to build your credit score, you don't have to necessarily use credit to build credit. Experian has this program called Experian Boost, and if you have utility payments or phone payments, you can have these payments added to your Experian credit report, which can also help build your credit score. The downside, though, is that the bills are only going to be on your Experian report. So if you apply for a loan and that particular lender pulls your Equifax or your TransUnion report, you're not going to have credit for those payments, and your score with those credit bureaus might not be as high. It's also important that you understand how cosigning works. Now, some young adults, they choose to build credit by either having their parents maybe cosign a loan for them, or their parents might add them as an authorized user on their credit card. If your parents are kind enough to do this for you, keep in mind that your actions will affect their credit. Even though you agree to make the monthly payments on a loan or credit card, this account will still appear on your parents' credit report. This is need to know information, because if you default on a loan or a credit card that your parents signed for, your actions, they don't only lower your credit score and affect your credit history, they also affect your parents. They are putting their credit and their name on the line to help you, and the best thing you can do to show your appreciation is to manage these accounts responsibly. We already talked about not getting in over your head and only charging what you can afford, but as far as your due dates, it also helps to maybe set up payment reminders. That way you don't forget, or maybe put your payments on autopilot. And if worst case scenario happens and you just don't have the money to pay it, don't ignore the bill. Ignoring it does not make it go away. It makes the situation 10 times worse. The best thing you can do, talk with your parents, let them know what's going on, and maybe you guys can work something out. It's also important to rethink deferring student loans. Now, typically after you finish college, repayment of student debt with a federal loan will typically begin 6 months after finishing school. Now, if you are having legitimate money problems, maybe you haven't found a job yet and you can't afford your payments, there is an option to either request a deferment or a forbearance, and both options buys you additional time, allowing you to temporarily postpone starting repayment without penalty. Now, this is very attractive because you get to keep your money. However, if you can afford to start paying on your student loans early, I highly recommend that you do this. Don't make the mistake that I made. After I graduated from college, I requested a forbearance multiple times. Not because I had to, but because I wanted to. I think each forbearance period was like 12 months, and then at the end of that 12-month period, I could apply for another one. And I did that, I believe, 4 different times. So as a result, even though I graduated college in 2001, I did not start making student loan payments until around 2005. But one thing I failed to consider as I was putting off these payments was that interest was going to continue to accrue throughout that entire time. So when I finally did start making the payments, the balance that I owed was considerably more than my original balance. And I have to say, that is probably one of my biggest financial regrets, because I think about how much extra money I paid unnecessarily. So if you're finishing school and you have cash available, definitely start paying on your loans as soon as possible. Even if you cannot afford to pay the monthly payment that they initially give to you, contact them, see if you can get it lower, because paying something is definitely better than paying nothing. It's also important that you don't rush to move out. Now, I completely get it. When you hit a certain age, the itch to really get out of your parents' home, it's pretty powerful. It's very strong because you're ready for independence. You're ready to be on your own, do your own thing. But if you can, I really encourage you to see if you can stick it out at home a little while longer, especially if you have credit card debt or student loan debt. Once you get out on your own, paying debt can become a much slower process and saving money becomes harder. By staying home a few more years, if everyone is agreeable, that's a great opportunity to really put a dent in your student debt, if not pay it off, and you can possibly use this time to build a solid emergency cushion. Even if you pay your parents rent, what they charge will probably be far less than what you would pay being out there on your own. And I understand that it is a sacrifice of your independence, but in the long scheme of things, if you look at the big picture, staying home 1 or 2 extra years is probably not the worst thing. It's important that you start saving for retirement ASAP. As soon as you get a full-time job with benefits, look into contributing to a 401k if it's offered by your employer. Start contributing as soon as you're eligible. Even if you have to start with as little as 3%, something is better than nothing. And as your income increases, you can then increase your contributions. And if a 401k is not offered at work, you can look into starting an individual retirement account. And starting early is so vital because it really gets you into a savings routine. You're used to this money coming out of your check, and then you're able to build your budget around the remaining income. If you wait until after you have a house, kids, and other responsibilities, when you look at your budget, it can appear as if you have absolutely nothing left to save. And if so, that can cause you to put off retirement planning even further. But although opening a 401k or an IRA is a great place to start, you should also learn about other investing opportunities while you're young. When I was younger, the ideal of investing in stocks, bonds, and other assets was something I thought you did when you were much older and when you had a lot more money. And looking back, my thinking could not have been further from the truth. The same way you want to start saving for retirement ASAP, you should also look into other long-term investment opportunities. The good news is that you don't need a lot of money to get started, and you don't even have to use a financial advisor. Many online trading platforms make investing easy as a newbie. And one good thing about investing young is that you really have time on your side. There's more time to generate wealth, and because you have years of investing ahead of you, you can also afford to take on more risk. It's also important that you don't ignore life insurance. Some young adults think that life insurance is unnecessary at their age, which, I kind of understand that. If you don't have any children or if you don't have a spouse, you may feel that you really don't need a policy. According to Insurance Quote, almost 2/3 of survey respondents between the ages of 18 and 29 did not have any form of life insurance. Some people thought it was too expensive, others thought it wasn't necessary, and some thought life insurance was only for old people. But even if you don't have a family to support, getting a policy, even a small policy, can make a big difference because chances are you will have some final expenses. And if you don't have a policy, this financial burden will fall on your family. Another thing to keep in mind is that getting life insurance as you get older also becomes harder because life insurance policies, approvals are usually subject to medical underwriting. And if you have a chronic condition, a lot of times this can result in you paying more for a policy, or the insurer may reject your application altogether. If you apply for a policy when you're in your 20s or your 30s and you're healthy, getting approved should not be an issue, and you will likely even receive a low premium. But if you wait until you're in your 30s or 40s and after you develop a chronic condition, you could end up paying a lot more for your policy. Now, as far as how much coverage you need, there really aren't any hard or fast rules. Now, obviously, If you are single, you don't have anybody relying on your income for support, you could probably get by with a small policy. On the other hand, if others do rely on your income, one general rule of thumb is to get a policy that's at least 8 to 10 times your annual salary. So there you have it. That's my list of simple money tips that can really help young adults jumpstart their financial life. I really hope that you enjoyed this video, and if you did, please give me a thumbs up. And if you haven't already, do consider subscribing. Again, on this channel, we talk about many different money topics. So if you like videos like this and you want to see more, I post every weekend and sometimes during the week. So thank you again for watching, and I'll see you guys in a few days.